Good evening, all the students. Myself, CMA Dr. NN Sengupta from this side. Today we'll be discussing the ratio analysis, and our faculty member has already joined. And thank you, Jagbandhu sir, for joining us. In fact, yesterday only he was here in Delhi, and today I think he has gone back to Mumbai and already joined the session and will be taking the session. 1 or 2 minutes about the ratio analysis, and then I'll try to get certain opinion from you people. It's a very critical chapter, ratio analysis from examination point of view, otherwise also from financial management point of view, because understand that how the company's finance position is. So we can find out that whether the company is doing well, company is having certain difficulties. And if we give an example of like we do our pathological test, blood test, let's say we test for our hemoglobin, whether our hemoglobin is correct or not. We test for glucose, not you people, but us, elders. We test blood pressure, not from blood, but through the help of some other machines. Then various WBC, RBC, various other parameters, liver function test, kidney function test. Similarly, on behalf of the companies, researchers or the person who is doing job in a company, or maybe who is doing the analysis of a company, can really find out different states of financial health of a company through ratio analysis. There are different forms. It may be through the liquidity ratio, through the solvency ratio, through capital structure ratio, through profitability ratio, and it can be from different angles. Okay, and certain ratios has been given in the study material, certain guideline has been given, but there is no thumb rule in various, ideal ratio. Normally, we may say that current ratio is 2:1, but it will depend on the company or will vary with the industry. So you have to be very careful about all these things, that how these things will be varying from one to another. And obviously there are certain limitations of ratio analysis as well. There are two type of question generally we see. One, financial statement is given, PL and balance sheet is given, and you need to derive the various kind of ratios. And second, various kind of ratios are given and you need to prepare the financial statement. These are in general, the ratios, the question we generally we see. Formula wise, you need to understand the basic logic behind that particular formula. And based on the given information, you need to use, different kind of what I will say information which is given in the question. Very important topic from examination point of view, and sir will try to take you through this particular topic. And if you have any feedback, any student who is there, may I know who is there that present. I'll just take 2 more minutes. Any student, any issue or any feedback, whether you have any problem you are facing or anything which you feel is good, can you please let me know? Gayatri, Harsh, Daksh, any of you can kindly speak for 2 minutes, please. Gayatri, two Gayatri is there. इनको open कर देना, please allow them to speak.
Sir, good evening, sir.
Yeah, good evening. Anything you want to say? Any thing you want to be added, or any feedback or any issue? If you can kindly share, please.
Sir, classes are going very good, sir. But now I am joining new to this live class, sir. I am following recorded sessions only, sir. So
Okay.
I am following recording session. Everything is good only, sir.
Chalo, good. Daksh. Daksh, Abhijit.
Good evening, sir.
Good evening, beta. Good evening.
Yes, sir. As you said priorly, every class is going good. But I wanted to tell you that yesterday I tried on filling the feedback form on the app, ICI BOS app. But I think so it was not getting filled due to, or I mean, getting submitted due to some internet connection or something like that.
Okay. I'll request the admin to help you and so that you can fill it up. Any other
Yes.
technical thing, beta?
No, sir, not any other.
Very good. Very nice. Very nice. Thank you very much.
Thank
Abhijit,
you.
Abhijit, Harsh. Harsh is there? Abhijit, you want to speak something? Harsh, you want to speak something, beta? Okay. Okay. Fine. Fine. Yeah, they have sent it through the chat. Any issue regarding the subject, regarding class, or any other things? Any feedback basically you want to give? Any improvement you feel where is required? Okay, okay, fine, fine. I think, sir, you can start. Thank you once again for joining us and taking these classes for the benefit of the students. Welcome to this particular session, and you can start the session.
Thank you, sir.
Sir, one feedback I have got from the student is to
Yes.
arrange one practical session, one practice session. So that we'll try to work out if one additional session we can give only for practicing the problem. That feedback I have got.
The revision session sort of we can plan on.
Yeah, that we'll see. Okay. Thank
Okay, so thank you, Gupta sir, for joining us, guiding the students. Now, let's just go for carrying forward this topic of ratio analysis. We have covered all the ratios till now and have also done 3 questions in our previous sessions. Now we'll be doing in this session some additional questions for discussion and practice, which will help us in better understanding the concepts and also to get an idea what sort of questions, what type of questions or what type of practicalities can we have from this chapter. So let's go for the question number 5. Let's go for question number 5, everyone. You are given the following figures relating to ABC Limited. Current ratio is given 2.5. Liquid ratio is given 1.5. Net working capital is 3 lakh. Stock turnover ratio is 6 times. Cost of sales upon closing stock. So stock turnover ratio is clearly specified that we have to take cost of sales upon closing stock. Then we have average debt collection period as 2 months. Fixed assets or fixed assets to shareholders' net worth is 0.8. And then we have also the reserves and surplus to capital as 0.5. Gross profit ratio is 20%. We have to prepare the balance sheet of the company as on 31st of December 2002 based on the above information. Okay, so we have to prepare the balance sheet. Now, remember, whenever we have these sort of preparation of balance sheet type questions, to get a clear direction as to what all needs to be computed, I would recommend you all to first prepare a draft balance sheet. I would recommend all of you to prepare a draft balance sheet. Whatever possible amount of data, you need to consider that. So let me just take this question and paste it in our solution sheet. Okay. So we have it. So whatever type of balance sheet assets and liabilities needs to be computed, first let's have a pro forma of it. And then we will get an idea as to what needs to be computed, right? So let's understand this. From the balance sheet, what all things can we, or from the question, we can definitely make out what all things needs to be computed for the balance sheet purpose. So we can see that there is current ratio given to us. There is quick ratio given to us. So definitely we can have from this the current assets. And since the quick ratio is also given, or the liquid ratio is given, we also need to compute some sort of stock, because liquid is anyways computed by subtracting stock. You can also say there could be also prepaid expense, but then the question is silent about prepaid expense being any other item, because there can't be two unknown things together. So for the time being, let us prepare this, the format. Okay, let me just have a small format over here, just for the purpose of sake of understanding what all needs to be computed. So we will need current asset, and in that current asset, we will need stock, and also you can see net working capital, stock will computed, debt collection or debtors collection. So we will also need the value of debtors, right? Any other item from current assets? No. So we can say the other things will be other current assets. So we need to compute all three of them. And also a total figure needs to be computed for current assets. So we need stock, we need debtors, we need other current asset, and the total of current assets also. Then of course, since we have the current ratio given to us, we will definitely have the current liabilities also to be computed. So current liabilities is also going to be computed. Now in that, what are the different types of current liabilities? No information is given in the question for the time being. So we can skip it. So we just need the other current liabilities figure. Then debtors collection, or you can say fixed asset to shareholders net worth is given. So we need to calculate the fixed assets value. Fixed assets value. And since we have the shareholders net worth, shareholders net worth is to be computed. Also reserves and surplus. So we'll say equity share capital is to be computed. And also the reserves. And then you take a total, which will be the net worth or shareholders net worth in totality. Okay, so this is how we compute the values of the balance sheet. You can say these are the items that we need. Now to start with, none of the item of balance sheet is given to us, but we have the information of net working capital. We have the information of net working capital. So how do we compute net working capital? It is current asset minus current liabilities. And then we have the current ratio as 2.5. So whenever you want to start this sort of question, start with certain value or certain number, like the value of fixed asset, the value of stock, or value of working capital, and then use it along with a ratio which is connected with that number. like in our case, net working capital is given to us, which is current assets minus current liabilities. And also we have the current ratio given to us, which is 2.5. So I'll be using both of them together now to get the values. So we all know that current ratio is simply computed as current asset upon current liabilities. Current ratio is computed as what? Current assets upon current liabilities. And that's given as 2.5. And on the other side, we have the net working capital as 3 lakh. Okay, so we can definitely say that this current asset is 2.5 times of current liabilities. And how do we get the net working capital? Net working capital is computed as current asset minus current liability as 3 lakh. So definitely current asset will be stated as 2.5 times of current liability, because we are just substituting this part in place of current assets. So in place of current assets, we have 2.5 times of current liabilities minus current liability is 3 lakh. So this is 1.5 times of current liability, which is 3 lakh. And definitely the current liability figure is coming out to be 3 lakh divided by 1.5, which gives us the current liability amount to be 2 lakh. So we get the value of current liability as 2 lakh. Right? So 3 lakh divided by 1.5, that gives us a current liability. So now we have the value of current liability available to us. So we can definitely say now the current liability figure is known to us, which is 2 lakh. We can also calculate after this current liability, current assets also. What will be the value of current assets, guys? Current assets will be 2.5 times of current liabilities, which is 2.5 into 2 lakh. So 2.5 into 2 lakhs is going to be 2.5 into 2 lakhs. That's going to be 5 lakhs. So current asset is equal to 5 lakh. Okay, total of all the current assets, we got the value of total of all the current assets as 5 lakh. Now let's go for the other aspects. We have used the current ratio, we have used the net working capital. Now it's time for us to use the liquid ratio. Okay, so liquid ratio or quick ratio. Liquid ratio or quick ratio, it is computed as current asset minus stock upon current liabilities. So liquid ratio is current asset minus stock upon current liabilities. So current asset is 5 lakh minus, we don't know the value of stock, but we know the value of current liabilities as 2 lakh. And this liquid ratio is equaling to 1.5. So this is definitely 5 lakh minus stock is 3 lakh. Right? So we get the value of stock as 2 lakhs. The value of stock is 2 lakhs. So we got this thing, which is stock is 2 lakh. Perfectly fine. Now next part is to calculate cost of sales, because cost of sales will give me sales from which I'll be using the debtors collection period as 2 months and will carry out the same classification further. Okay. So now for this, since we have the liquid ratio or stock computed, we have this number called as stock turnover ratio. Stock turnover ratio. So stock turnover ratio is cost of sales upon stock. Now we can take average or closing or whatever, but now since we just have the one figure, which is the closing stock, so we'll say here that cost of sales upon stock is 2 lakh, and this stock turnover is 6 times. So that gives us the cost of sales as 12 lakhs. That gives us the cost of sales figure as 12 lakh, right? So we have the cost of sales as 12 lakh, and to compute now the value of debtors, we'll be using the average debt collection period, which is 2 months, but that is based on the sales value. Okay, that's based on the sales value. Now, since this is based on sales value, I need the value of sales. Now, for sales, we have the GP ratio, gross profit ratio, as 20%. So, since we're saying the GP ratio is 20%, how do we calculate the GP ratio? GP ratio is computed as gross profit upon sales into 100. We get the gross profit as what? Sales minus cost of sales upon sales into 100, and this GP ratio is 20%. So of course, we don't know the value of sales, but we definitely know that cost of sales is 12 lakh. So what will be the value of sales? It's going to be sales minus 12 lakh is equal to 0.2 times of sales. Therefore, 0.8 sales will be 12 lakh, and sales will be 12 lakh divided by 0.8, which is 15 lakhs. So this is sales, which is 15 lakhs. So sales is amounting to a total of 15 lakhs. Okay, we got the sale value. Now sale value is going to tell us how much do we have the debtors value, because average debtors collection period is 2 months. And I think all the sales we can assume it as credit sales because there's no specific information given in the question. So we can definitely say all our sales are credit sales. So we will say what is debtors collection. So debtors collection period is 2 months. So debtors collection period is 2 months. So from this, we can definitely get the debtors turnover, because we have the formula for debtors collection period. We generally calculate the debtors collection period as 12 divided by debtors turnover. So that gives us the answer for debtors turnover formula. Debtors turnover is 12 divided by debtors collection period, which is simply 12 divided by 2, which is 6 times. And since our debtors turnover is computed as sales upon value of debtors, this is 6. So we know the sales value as 15 lakh. So 15 lakh upon debtors is 6. So what will be the value of debtors? 15 lakh by 6. Value of debtors will be 15 lakh by 6. So how much is 15 lakh by 6? That's 2.5. 5 lakhs, or we get the value of debtors as 2,50,000. So we got the value of debtors as 2,50,000. Of course, what will be the other current assets? Value of other current assets. What will be the value of other current assets? Other current assets will be the balancing figure, which is just 50,000. Okay. So we have the fixed asset to shareholders net worth to be used now. We use the average debt collection as 2 months. So fixed asset to shareholders net worth is 0.8. Fixed asset to shareholders net worth. Now we don't know what is fixed asset. We don't know what is net worth. But we have the reserves and surplus to capital as 0.5. So we have the relation between reserves and surplus to capital. Now over here, we are somewhere in a situation where we don't know two items together. We don't know one asset, we don't know one liability. But the best part is we know the rule that your total assets should be equal to total liabilities. So let's simply use that rule to help us with this fixed asset to shareholders net worth. So fixed assets to shareholders net worth, that is something we need to check. Okay. So let us go for what is the total of all assets. Total assets, it's going to be fixed asset plus 5 lakh. Total liabilities is going to be current assets, current liabilities plus the net worth, because there is no long-term debt given in the question then. Okay. So total liabilities is current liabilities of 2 lakh and net worth plus 2 lakh. And we have the ratio as fixed asset to shareholders net worth. We have the ratio as fixed asset to shareholders net worth. And the ratio is given as fixed asset to shareholders net worth as 0.8. This obviously implies fixed asset is 0.8 times of net worth. This is our equation number 1. This is 2 and this is 3. So we simply say substitute third equation in the first equation. So we get this as total assets is equal to 0.8 times of net worth plus 5 lakh. And this is our fourth equation. Now, of course, we know that total assets and total liabilities are equating with each other. So we'll say since total assets is equal to total liabilities. So we are aware that total assets and total liabilities should be equal. So it simply means total assets is 0.8 times of net worth plus 5 lakh and total liabilities is net worth plus 2 lakh. This is net worth plus 2 lakh. So that gives us like 5 lakh minus 2 lakh is net worth minus 0.8 times of net worth. So this is 3 lakh equal to 0.2 times of net worth. So what about the net worth? Net worth will be 3 lakh divided by 0.2. Net worth is 3 lakh divided by 0.2. That gives us the value of net worth to be 3 lakh divided by 0.2. 3 divided by 0.2. which is 15 lakh. Okay. So we have the value of net worth computed as 15 lakh. So net worth is 15 lakh, which is the total of equity, share capital and reserves, which is 15 lakh. Now, let us try to understand how do we get the fixed asset. Since we know that fixed asset value over here, we have the fixed asset to net worth as 0.8. Okay, so we'll say since fixed asset upon, or we already know that since fixed asset is 0.8 times of net worth, so that is going to be 0.8 times of 15 lakh, which is 12 lakh. So 0.8 into 15 lakhs, that's going to be 12 lakh. Okay, so we get the fixed asset value as 12 lakh. You can definitely say that balance sheet tallies at what? 17 lakh, but still there are two more items which needs to be computed, which is equity, share capital and the reserves. And for that, we have this ratio, reserves and surplus to capital is 0.5. Let's use that ratio. Reserves to capital, reserves to capital ratio is 0.5. So we have reserves to capital ratio as 0.5. Daksh, we got the OCA as a balancing figure. The other current assets was computed as 50,000 to balancing figure because we already got 2 and 2.5. So out of 5 lakh, 50,000 balancing figure will be other current assets. Okay, reserves and surplus is 0.5. Now, we know that net worth is reserves plus capital, which is 15 lakh. So we can definitely say that reserves is 0.5 times of capital. So reserves is 0.5 times of capital plus capital is going to be equal to 15 lakh. So we have 1.5 times of capital as 15 lakh. Okay. And therefore we get the capital figure as 15 lakh divided by 1.5, which is 10 lakh. So in the balance sheet, we can say reserves is, or we got the capital as 10 lakh. And reserves is 5 lakh. Okay, so reserves is your balancing figure again, 5 lakh. So this completes our entire balance sheet figure, balance sheet format base. So we have computed whatever was possible. So we have computed whatever was possible from the given, ratios. Okay. I did not understand by total assets and reserves calculation. Total assets is just the total of your fixed asset and current assets. So total assets was taken as fixed asset plus current assets. And reserves was calculated by taking this ratio. We had the ratio of reserves and surplus to capital. We have this ratio of reserves and surplus to capital. And we also have the net worth number as 15 lakh. So I just substituted this reserves and surplus being 0.5 capital in place of this reserves. Okay. Can I again explain GP and debtors collection? GP is gross profit ratio. So that is gross profit upon sales into 100. And gross profit was computed as what? Sales minus cost of sales. It's going to be simply sales minus cost of sales upon sales into 100. The gross profit ratio is going to be GP upon sales, which is sales minus cost of sales upon sales into 100, which gives us 20. That ratio is given as 20. And we know that sales figure is something unknown, but we know the cost of sales as 12 lakh. The cost of sales is substituted over here, right? And then you solve this equation to arrive at the sales value. And then we have the debtors collection period is 2 months. Now debtors collection period formula is 12 upon debtors turnover. So this is 12 upon debtors turnover. From this, we get the debtors turnover value as 6 times. And then we apply the debtors turnover formula to arrive at the value of debtors. Okay, this question will come for how much marks? You can say it would be for what? 6 or 7 marks maybe, or max 8. Okay, so this is the full-fledged ratio question. I hope you were able to understand how did we calculate. Now, next question is going to be a similar type of question. So would you like to try it on your own, or shall we go it in the same way as we did this question? Would you like to try that question on your own? So just maybe try it in rough, maybe take around what 5-10 minutes, and then I will start with the formal solution. Is it good, everyone? Are we good with this? Yeah, because otherwise, if I just keep on solving, then the problem will be, you may not be able to grasp as to what we need to compute, right? So let us take up now the question. Okay, try out this question 7. Question 7 is, just ignore this fixed asset part of, after writing of 30%. There's nothing to do with this. Okay. I think the rest of the questions is fine. So you have to prepare a balance sheet of this company Zinc, where we have the ratios and certain values given to us. Try to calculate it, guys. Prepare a draft format of balance sheet and then calculate individual values. Prepare a draft format and then go ahead with the calculation of individual values. Try to fill up the balance sheet numbers as much as possible from the ratios, and many values you can obtain it by way of as a balancing figure. So just let me just give you an idea as to what all things we need to calculate over here. Okay, so let me prepare a draft balance sheet for you, and then we can think of calculating the items that are needed. So over here, definitely, since we have the fixed assets value, the fixed asset value is already given to us. So that is computed. 10,50,000. Okay. Then we have fixed asset turnover ratio. So possibly to compute the cost of sales, we'll get the finished goods. Yes. This is going to be a new sort of thing in our calculation, because in current assets, we're going to calculate the finished goods value. So under current assets, we will have the value of finished goods to be calculated. Then we will have gross profit on sales, net profit. That's for computing COGS. We'll get the net profit number before interest. So remember, this is going to be before interest. So this is your earnings before interest and tax. Fixed charges cover is going to be 8, because you have the debenture interest as 8. So we'll definitely have on the liability side the value of debentures to be computed. Okay. Then we will have the value of debtors to be computed. Material consumed to sales, and definitely we'll have the stock of raw material also in the balance sheet. So we'll have to compute the raw material stock. So in this question, there are 2 inventories that we need to compute: finished goods and raw material stock. Then we have the ratios of current ratio, quick ratio. So of course, quick ratio will be taking into account both the stocks, and in other case, on the liability side, we need to compute the current liabilities. So current liabilities needs to be computed. Maybe over here we'll have other current assets, and then the total of current liabilities or current asset needs to be computed. And then we have reserves to capital ratio. So reserves to capital ratio, it means we will have equity share capital and reserves also to be calculated. So total of all of them is going to be the net worth. So these are the items that we need to compute. Now, once we have the idea, once we have the roadmap for us, what needs to be computed, we can definitely start with all calculations. And as I said, you have to initially start with a number and its associated ratio. So we have this fixed asset as 10 lakh, and the associated ratio with fixed assets, in our case, it's going to be fixed asset turnover ratio, which is on the basis of cost of sales. So we have to first get the cost of sales. To use these 2 ratios, using these 2 ratios, you can calculate first the cost of sales. So give me the cost of sales value. Give me the value of cost of sales. Give me the value of cost of sales, because fixed asset turnover ratio, as this formula says, fixed asset turnover is going to be cost of sales upon fixed asset value, which is 2 times. We know the value of cost of sales. We know the value of fixed assets. We have to get the value of cost of sales. So give me the cost of sales value. Cost of sales. Yes, Pooja, you are correct. 21 lakhs. Okay. So we say this is going to be cost of sales upon fixed asset of 10,50,000. That's equal to 2. So we can say cost of sales is 21 lakhs. Okay. So once you have computed the cost of sales as 21 lakhs, once you have computed the cost of sales to be 21 lakhs, now we can definitely use the cost of sales for computing the finished goods and other items. So we got the cost of sales as 21 lakhs, but cost of sales is not something that will go into the balance sheet thing. That will be used for finished goods. Now the question gives us finished goods turnover ratio is 6 times. Finished goods turnover ratio, which is cost of sales upon finished goods stock, is 6. So we know the cost of sales as 21 lakhs upon finished goods is 6. So what will be the finished goods stock value, everyone? What will be the stock of finished goods value? Yeah. It will be 21 lakh divided by 6, which is 3 lakh 50,000. So we got one item of our current assets, which is finished goods, 3 lakh 50,000. Okay. We got 3 lakh 50,000. Now, finished goods turnover ratio on cost of sales, we used it as 6 and we got the value of finished goods. Now we definitely have the cost of sales value. We have the cost of sales value, and there we are having the GP ratio on sales as 25%. So of course, we can get the value of sales also. Now in this case, gross profit ratio is given as 25%. You know, this gross profit is computed as sales, or this is simply computed as gross profit upon sales into 100. So gross profit is simply computed as sales minus cost of sales upon sales into 100. Now, of course, this 25 is equal to sales minus cost of sales. Cost of sales was computed as what? 21 lakhs. So this is divided minus 21 lakh upon sales into 100. So you can just solve this and give me the value of sales, everyone. What's the value of sales? Solve this equation and give me the value of sales. What is the value of sales? The 3.5 lakh was the value of stock, finished goods. It's not value of sales. Okay, what's the sales value? 28 lakhs. Correct? It is 28 lakhs. Because you will see, obviously, this will be computed like 100. This 100 divided by 100 will get divided by 25. So 25 upon 100. Right? So 25 upon 100. Then you have 0.25, and solving all of that is going to give you the sales value as 28 lakh. Well, this 28 lakh is of no use in our balance sheet. But wait, this is going to be used when we are looking for net profit to sales ratio, which is 8%, which is before interest figure. So this is like net profit or profit before interest and tax to sales figure is 8%. So let us use that number now. Profit before interest and tax upon sales is 8%. Or your before interest and tax margin is 8%. So we can say profit before interest and tax is 28 lakh into 8%. 28 lakh into 8%. So we have that as 2,24,000. So profit before interest and tax was 2,24,000. Now we will use the fixed charges cover, which is debt interest. And now here fixed charges, they mean the debenture interest. So when we are talking of fixed charges, we are talking of the debenture interest of 7% is 8. So there's no information about principal repayment. So we can simply calculate this fixed charges coverage ratio as profit before interest and tax divided by the interest, because there's no information about specific information about the depreciation or principal repayment. So we can say it is similar to like your interest coverage. So profit before interest and tax is given as 2,24,000. Upon interest is something we don't know, but we know the fixed charges cover ratio is 8 times. So obviously, what will be the amount of interest from this? Can we compute the amount of interest from this? What will be the amount of interest? What is the amount of interest? What's the amount of interest, everyone? 28,000. Okay, perfect. So we have the interest as 28,000, but where is this interest going to be in the balance sheet? Of course, this interest is not going to be mentioned in our balance sheet. It will be there in our P&L. But the most important part is fixed charges cover, and we say that debenture interest is 7%. So of course, this 28,000 that we computed, that is representing the 7% amount of interest. So of course, interest will be computed as what? We compute the interest as debenture value into 7%, because 7% is the rate of interest. So this interest of 28,000 is debenture into 7%. So therefore, we have the value of debenture as 28,000 by 7%. So how much is 28,000 by 7%? What will be the value of debentures? 4 lakh. Correct? So after doing so much of calculations, we are getting the value of debenture in our books, which is 4 lakh. Perfect. Great. Let's start using the other ratio items now. We use the fixed charges coverage. It is done. Now we have to look at the debtors collection period is 1.5 times. So debtor collection period or debt collection period is 1.5 times. And we have computed the sales value, everyone. Sales is 28 lakh and debtors collection period is 1.5 months. So can you use these both items? So we have the debtors collection as 1.5 months. So use both these items of sales and debtors collection period to give me the value of debtors. Give me the value of debtors using these two items. use both the sales and debtors collection period to get the value of debtors. First, remember, you need to get the value of debtors turnover. Yes. What's the value of debtors? First, we need to get the debtors collection period formula correct. So debtors collection period was 12 divided by debtors turnover, which is 1.5. So that will give us the value of debtors turnover as 12 divided by 1.5. What's the debtors turnover number? 8. 8 times, right? So debtors turnover is 8 times. Okay. So debtors turnover is 8 times. And how do we calculate the debtors turnover? Debtors turnover is calculated as sales, which is obviously the credit sales, upon debtors value. So this is 8 equal to 28 lakh upon debtors. So what is the value of debtors, everyone? Value of debtors? 28 lakhs. Divide by 8, which is 3,50,000. Perfect. So we get the value of debtors as 3,50,000. Perfect. Value of debtors as 3,50,000. Now we have this ratio of material consumed to sales. So whatever is the value of sales, 30% of that is the value of material consumed. 30% of that is the value of material consumed. So material consumed to sale. So material consumed will be 30% of sales, which is 30% into 28 lakh. 28 lakhs was the value of sales, right? Yeah. So how much will be the material consumed? Value of material consumed is, what's the value of material consumed? 28 lakh into 30%. 28 lakhs into 30%. Material is 8 lakh 40,000. Perfect. So over here we have the raw material figure as 8 lakh 40,000. Great. Then we have wait. This was material consumed. My bad. There is one more item needs to be done. This is not the amount of material. This is the amount of material consumed. Now we have to get the stock of raw material. So stock of raw material is 3 months of your consumption. So stock of raw material, we have the value as stock of raw material is material consumed. Stock of raw material is material consumed multiplied by 3 by 12, because the question says that whatever is your material consumption for the entire year, 3 months of that is kept in the stock. 3 months of that is kept in the stock. So what is the stock of raw material? That's going to be 8 lakh 40,000 being the material consumed into 3 by 12. So how much is it? Yeah. What's the stock of raw material? 8,40,000 into 3 by 12, 2,10,000. Okay. So we have the stock of raw material filled up now over here, which is 2,10,000. Perfect. Then we have the current ratio as 2.4 and quick ratio as 1. So we know that current ratio is computed as current assets upon current liabilities. Quick ratio is computed as what? Current asset minus stock upon current liabilities. So both the ratios need to have the total current liabilities and total current assets, right? So you have to use both the ratios simultaneously and get the value of current assets and current liabilities. So just 2 minutes time for you. Try to form an equation and get the value of current asset and current liabilities. Total current assets and total current liabilities. Try to get it. Yep. Are we able to get it? So you should get the formula as one is current ratio is 2.4. So we know the current ratio is 2.4. Quick ratio or liquid ratio is 1. Current ratio is current assets upon current liabilities, which is 2.4. Quick ratio is current asset minus stock upon current liability is 1. So definitely we can say current asset is 2.4 times of current liabilities. This is going to be one of the things. And this is current asset minus stock will comprise of two things. One is a stock of raw material and stock of finished goods. Stock of finished goods was 3,50,000 and stock of raw material is 2,10,000. So it is minus 3,50,000 minus 2,10,000 upon current liability is 1. Of course, this can be substituted over here. So we'll have 2.4 current liability minus 5,60,000 upon current liability is 1. I think you should be able to solve this and get the value of current liability. Give me the value of current liabilities from this. Yeah, current liabilities is 4 lakh. Great. So since current liabilities is 4 lakh, current assets will be 2.4 times of current liabilities. So which is 2.4 into 4 lakhs. So 2.4 into 4 lakhs will be amounting to how much? 2.4 into 4 lakhs. This is 2.4 into 4 lakh, which is 9,60,000. 9,60,000 is the value of current assets. So current assets is 9,60,000, current liabilities 4 lakh. This is 9,60,000. Current liabilities is 4 lakh. Okay. Now can we get the other current assets value? Definitely yes. Other current assets will be the balancing figure. So what's the balancing figure? Other current assets. The balancing figure, other current assets. Balancing figure, other current assets. 50,000, right? Okay, great. Now, the final part that we are left out with is the equity and then the distribution between share capital and reserves. So for that, the simple thing to be done is matching the assets and liabilities. So total of all assets is 10,50,000 plus 9,60,000. So total of assets is what? 20,10,000. Obviously, that same total should be even for the liabilities, right? So we can say since total liabilities should be equal to total assets, which is equal to 20,10,000. So therefore, equity share capital plus reserves plus debentures of 4 lakh plus current liabilities of 4 lakh. This should be totaling to 20,10,000. So therefore, we can say equity share capital plus reserves should be equal to how much? 20,10,000 minus this 8 lakh, which is 12,10,000. Okay, so we got the value of equity share capital plus reserves as 12,10,000. Now, one important part that we're left out to be calculating is reserves to capital ratio is 0.21. So how much will be reserves and how much will be capital? Reserves to capital ratio should be 0.21. So reserves to capital, they're saying it is 0.21. So it is reserves upon capital is 0.21. So we can say reserves should be equal to how much? 0.21 capital. So let us substitute this as equity share capital plus 0.21 equity share capital is equal to 12,10,000. So what will be equity share capital? What should be equity share capital? The value of equity share capital, everyone. 10 lakhs, yes. Equity share capital will be valued at 10 lakh. And obviously, since this is 10 lakh, this is going to be 2,10,000. Okay. Are we good, everyone? Yep. Did you all get the values? Yes. 20,10,000 is the balance sheet total. And we got the remaining values of the balance sheet. Okay, so with that, let's just take a break right now. We have done a couple of questions, maybe 2 more questions we will be doing after the break. So let's take a break of around 10-15 minutes and we'll be joining back to discuss few more questions. Okay, take a break, guys. We all there? Everyone? Okay. So we did this question 7. Now let's try to calculate or solve. Yeah, question number 16. We'll try guys. Question 16. Yes, question 16, everyone. Will you try it or shall I solve it? Will you solve it? Question number 16. We have all the turnover ratios given. Fixed asset turnover, capital turnover, receivable turnover, payable turnover, gross profit ratio. Gross profit is given. So of course, from the gross profit, you will get sales and also COGS, and then you can use each of these turnover ratios to calculate the value of assets and liabilities and then prepare the balance sheet. So just for you, to begin with, I'll just give the format of balance sheet or what all things needs to be computed. And then I think after that, you will be good to calculate. So you will definitely need capital. In current assets, you will need inventory, receivables, and other current assets. Then you will have current liabilities, inventory, receivable. Then you will also have the fixed asset value. So you need the capital, reserves, and surplus. I'll just keep it as reserves. So we'll need capital, we'll need reserves, current liability, fixed asset, inventory, receivables, other current assets. There is no long-term loan. Reserves and surplus is given. Okay, reserves and surplus is given to us as 2 lakh. And make a note that ending inventory of the year is 20,000 above the beginning inventory. So whenever you're calculating inventory turnover, make sure you use the average inventory. Okay, so will you solve it? Will you try to solve it? Everyone? Will you give it a try? Yes, okay. Just try it out in a rough format, and then I'll give the proper solution for this. Try it, guys. Give it a try, everyone. Yes, Anchal. Yes, Anchal.
Sir, when will you upload notes of first chapter and last chapter of ratios?
It is done. It's already done on the portal. Check the portal. Is it not there yet?
I yesterday visited, but that's not uploaded. I have to check again.
Yeah, it's already done. I think last week itself I have done, and I have also uploaded these questions also.
Okay, sir. I will check.
Okay, not there. Okay, I'll just inform the admin about it. So I have
Yeah.
uploaded, but I think they have not yet released to you possibly.
Yes, sir. It's not released yet.
Okay, I'll do that.
Okay.
Okay, what does net assets comprise of? Net assets? Where do you find the net assets? I don't think there is any need for net asset calculation. And for capital turnover, okay, for capital turnover, it will be there is no debt in this case. So it will be just capital and reserves and surplus, share capital and reserves and surplus. Or if it will say net assets, then it will be total assets minus current liabilities. Also for receivables and payable turnover, what we have to take into denominator. For receivables, it has to be sales, and for payables, it has to be purchases. For receivables, it has to be sales in the numerator, and for purchases, it should be payable. It should sorry for payables, it should be purchases in the numerator. In denominator, it will be the value of receivable and value of payable. Okay, capital 14 lakh, fixed asset 4 lakh, average inventory 4 lakh, receivable 8 lakh. Okay, fine. So let me start now. You guys can then check your answers then. Okay, so fixed asset turnover is 8 times. And I mean, only ratio which I can associate with the number is the GP ratio. So we have the GP ratio as 25%. So GP ratio is 20%, 25% means it's going to be gross profit upon sales. So this is simply essentially going to be 0.25 is equal to gross profit is 8 lakhs upon sales. So the sales value is going to be 8 lakh divided by 0.25. So what's the value of sales? What the value of sales is? 32 lakhs. We got the value of sales as 32 lakhs. And then cost of goods sold will be sales less gross profit. So sales is 32 lakhs minus gross profit of 8 lakhs. So COGS works out to be 32 lakhs minus 8 lakh. That's what? 24 lakhs. Correct, everyone? COGS is 24 lakhs, correct? Did we get it? So we have the COGS, we have the sales. Now fixed asset turnover, from that, of course, I can use the sales, and from that I'll get the value of fixed asset. So fixed asset turnover is 8 times. So this fixed asset turnover 8 times, it will be computed as sales upon fixed assets, so which is 8 equal to 32 lakhs upon fixed asset. So what's the value of fixed asset, everyone? Value of fixed asset. Four lakhs. Great. We got the value of fixed asset as 4 lakh. Capital turnover is 2 times. Let's use that number. Capital turnover is 2 times. So capital is going to be sales upon capital, which is equal to 2. So sales upon capital is 2. So we can say sales is 32 lakhs upon capital means, of course, it's going to comprise of equity share capital plus reserves. So this equity share capital plus reserves is 2. Therefore, equity share capital plus reserves is 32 lakh by 2, which is 16 lakhs. Okay. So capital, you can say share capital plus reserves. Also net assets you can use. So equity share capital plus reserves is 16 lakh. We have a ratio, I mean reserves and surplus is 2 lakh. So definitely the equity share capital is going to be how much? How much is equity share capital? 16 lakh minus 2 lakh, which is 14 lakhs. Got it? Share capital is what? 14 lakh, everyone? Did we get it? Share capital 14 lakhs. Perfect. Okay. So we've got the share capital reserves. Now let's go for inventory turnover. Okay. So let's have a look at inventory turnover. Inventory turnover is given as 8 times. But in inventory turnover, we take COGS upon inventory. So COGS upon inventory, what is the COGS value? 24 lakh. So this is 24 lakh divided by average inventory. Normally we take the average inventory. So what's the value of average inventory, everyone? What's the value of average inventory? What is the average inventory? What's the average inventory? 3 lakh. Okay, so this 3 lakh is actually opening plus closing, and there is information that ending inventory is 20,000 above the beginning inventory. Okay, so the average inventory is opening stock plus closing stock by 2. So therefore, opening plus closing is 6 lakh. Opening plus closing is totaling to 6 lakh. And the question says that the ending inventory is 20,000 above the beginning inventory. So closing inventory minus opening inventory is 20,000. So ending inventory is 20,000 more than the opening inventory. Okay, so I can say closing inventory is 20,000 plus opening inventory. So let us just substitute this over here. Therefore, opening inventory plus 20,000 plus opening inventory is 6 lakh. Therefore, 2 times of opening inventory plus 20,000 is 6 lakh. So we have 2 times of opening inventory as 5,80,000. We get the opening inventory as, what will be the opening inventory? 2,90,000. And closing inventory will be 3,10,000. Right? So 3,10,000 is the value of closing inventory we got. So we got the value of inventory, closing inventory as 3,10,000. So we have done with opening, capital, inventory is done. Coming to receivables turnover. Receivables turnover is 4 times. Receivables turnover is 4 times. So receivables are computed as what? Sales upon receivables. So in the question, there is no information about credit and this sales. So we can definitely say that entire sales is on credit. So 32 lakh will be the sales figure. So 32 lakh divided by receivables. So the value of receivables that we have is going to be how much? What's the value of receivables? Value of receivables, 8 lakh. Okay. Receivables is done. Inventory is done. Receivables is done. Then payables turnover is 6 times. So we'll have to use the payables formula. Payables turnover is purchases upon payables. Payables turnover is given to us. The payables turnover number is 6 times. So this is 6 is equal to purchases upon payables. I have a doubt in inventory. What's the doubt? Inventory turnover is 8 times, right? And inventory turnover is computed as COGS upon inventory. So inventory turnover is computed as COGS upon inventory. So 8 is going to be 24 lakh upon average inventory, because normally all our turnover ratios are going to have the average in the denominator. So that's going to be average turnover, average inventory. So average inventory, we get it as 24 lakh divided by 8, which is 3 lakh. So average inventory is 24 lakh divided by 8, which is 3 lakh, and that was opening plus closing by 2. So opening plus closing is going to be 6 lakh, and then we have the closing minus opening as 20,000, and the closing figure is 20,000 plus opening, and we just substitute this in this equation and we get the opening and closing figures. Okay, so we get 3 lakh as the average inventory. That average inventory is going to be average of opening and closing. And the question says that your closing inventory is 20,000 more than the opening inventory. Okay. Now, with regards to purchases, we'll have to calculate like the purchases value. So purchases, we know it is COGS is opening plus purchases less closing. Okay. So I can get the purchases figure as COGS minus opening plus closing. So it is going to be COGS minus opening plus closing. We know the COGS figure. Cost of goods sold figure is what? 24 lakh. So this is 24 lakh minus opening is 2 lakh 90,000 and closing is 3,10,000 divided by the value of payables. So you can solve it and get the value of payables. So what is the value of payables, everyone? What's the value of payables? What's the value of payables? Payables value 4,03,033. 4,03,333, right? Got it? 4,03,333. Okay, so we got the value of payables now, or that's going to be a current liabilities. So we have got which values? We've got the fixed asset is done, equity share capital is done, payables is done, inventory is done, receivables is done. Right? Receivables is done, payables value is also done. Now we have just left one thing to compute, which is the other current assets. Now, other current assets will be, of course, the balancing figure. Okay, so what will be the other current assets? Let's try to figure it out. Fixed asset is 4 lakh. Then you have receivables, inventory, other current assets. Receivables is 8 lakh. Your payables is 4,03,333. Inventory, closing inventory is 3,10,000. Equity share capital was 14 lakh and reserves is 2 lakh. So what's the other current assets value? Balancing figure, guys. Other current assets value will be the balancing figure. Okay, 4,93,333. Fine. Perfect. Absolutely fine with this question now, which was question number 16 from our analysis. Now, let's try to answer this question 17. Question number 17. I'll just give you a couple of minutes. Just think about each of these options. Read the question and try to put the answers in your mind. Okay, so assuming the current ratio of the company is 2, state in each of the following cases whether the ratio will improve or decline or will have no change. First, payment of current liability. Okay, so if you make a payment of current liability, what's going to happen to your current ratio? Is it going to improve or decline? Well, let us say your current ratio was computed as 200 upon 100. And let's say out of that, you paid 50. So of course, your liability will also fall by 50 and your asset will also fall by 50 because 50 is going to be reduced from your cash balance. So you have 150 upon 50. So now the ratio is 3. So of course, in case of payment of current liability, the current ratio is going to improve or it's going to increase. Absolutely correct. Second one, purchase of fixed assets by cash. What do you think in the second case? Purchase of fixed assets by cash. What's going to happen in that situation? If you're going to purchase your fixed assets by cash, you will be losing out cash. I mean, you'll be paying out cash. Cash will be decreased. Cash will fall, right? And fixed asset value will increase. But in case of current ratio, your numerator, current assets is getting reduced. Your current liability still remains the same. So of course, over here, the current ratio is going to fall. Okay. Third case, cash collected from customers. So in case the cash is collected from customers, what's going to happen? Cash collected from customers. Cash collected from customers. Any change or no change? Well, if you collect cash from customers, your debtors reduces. Cash balance increases. The total current assets still remains same. Your total current assets still remain same. So you can say in this situation, there is no change in the current ratio. Fourth one, bills receivable dishonored. So what will be the case in that situation? Bills receivable dishonored. Bills that you have received dishonored. Then of course your bills receivable value will fall and the debtors value will increase. So total current assets remain same. So there's not going to be any change in your current ratio. Okay. Fifth one, issue of new shares. So if you're issuing new shares, what's going to happen to the current ratio? It will increase because current assets or cash increases, right? So current assets or cash increases and it reduces, current liabilities remains the same. So this is going to improve your current ratio. Are we good, everyone? Okay, fine. Now let us do some quick MCQs. Well, let's do certain MCQs for discussion. And the screen. Okay, so here we go. These are the questions. Okay, try out these first two questions is. Try to calculate the first two questions. Okay, the first one answer. First one is balance sheet extracts are given, which comprise of inventory, trade receivables, cash and bank, prepaid expenses, trade payables, short-term bank overdraft, and we have to compute the current ratio and quick ratio. So, which is the accurate one? Current ratio. We'll have to first take current assets. Current assets are equal to 3,60,000. 3,60,000 of receivables plus 4,80,000 of inventory, cash and bank balance of 1,20,000, and prepaid expense of 40,000. Current liability is 3 lakh of trade payables and bank overdraft of 2 lakh. So current ratio is simply 10 lakh divided by 5 lakh, which is 2. And when it comes to quick ratio will be current asset minus inventory of 4,80,000 and further prepaid expense of 40,000 divided by the current liability, which is 0.96. I think inventory and prepaid expense is 40,000 and current liability is 5 lakh. So 0.96. So most accurate one is option B. Right, so 0.96 you can say, but we have over here as the quick ratio number as 1, which is 0.96 approximately rounded up to 1. So that gives us this particular option B. What about the second question? Second question, we have to minus overdraft. No, we're not supposed to subtract overdraft. Why should we subtract overdraft? For quick liabilities. No, because normally we don't subtract overdraft unless and until the question says it. Because if you look at our material also, one second, just let me recheck the material. I don't think that in our material we are subtracting the bank OD. So in the quick ratio, current liabilities, yeah, it has to be taken current liability. We not subtract bank OD. Okay, second question. Second question, what's the answer? Second question, you have to compute the return on capital employed. What's the return on capital employed? Yes. Second question answer is 44.76 because we have profit after tax as 12 lakh. So we first need to get, since we want the return on capital employed, I need to get the EBIT. Okay. In EBIT, Pooja is asking the MTP while calculating quick ratio, subtract, they have subtracted the overdraft from current liabilities. But from the recent material, Pooja, it is clear that we have to take only current liabilities. The 2026 version of material, it asks for current liabilities not to be subtracted. I mean, OD not to be subtracted from current liabilities. Okay. So EBIT is going to be computed as 12 lakh divided by 70%. And then you add interest of 3 lakh. So that's simply 12 lakh divided by 70% plus 3 lakh. Okay, EBIT. So return on capital employed will be this divided by EBIT divided by 20 lakh of share capital, 10 lakh of reserves, and 15 lakhs of debentures. So 44.76 is the accurate answer. What about question 3? Question 3. Calculate the debt equity ratio and total debt ratio. Yeah. Third question. What's the answer? Option A. Third question answer is option A, guys. Yeah. So it is simply, since it is debt equity ratio, you take the debt as 2 lakh outstanding expenses. Sorry, 2 lakh of 20 lakhs of long term debt and 30 lakhs of debentures, and you divide it by equity and reserves. So that's one. And for the second question, it is going to be total debt, it is 50 lakh upon shareholders' funds. So shareholders' fund is anyways total debt, which is total debt plus shareholders, which is 1 crore. So that comes out to be 0.5. Right. So that's about this MCQ. And with that, we are just ending our session today. And we have our session again on Saturday, wherein we'll be starting with a new topic. Okay. With that, let's just call it a day. See you again on Saturday, guys. Good night and take care. Bye, guys. Enjoy.